Hi, I'm Vincent Scarsella, Director of Research and Investment Development at Sgroi Financial. On this segment of Market Moves, we'll take a closer look at what happened in the first quarter and also what to expect for the rest of the year. The U.S. stock market started 2024 the same way it ended 2023, risk on. Optimism over the economy and interest rate cuts, combined with investor exuberance over artificial intelligence, has propelled the S&P to finish the first quarter up over 10.5%. The tech-heavy NASDAQ was right behind, rising over 9%, while the blue-chip Dow advanced over 6%. Finally, small-cap stocks, as measured by the Russell 2000, were up 5.2%. The S&P 500 built on a nice finish to end 2023 and has set 22 record new highs without a significant pullback so far this year. And it was actually the best first quarter since 2019. Major keys to this year's gains have been confidence from investors that the economy is heading towards that soft landing in which inflation moderates and the economy avoids a severe downturn. Another tailwind has been the dovish Federal Reserve, which reignited investor confidence at their last meeting, where they hinted 3 rate cuts are still coming in 2024, while increasing their expectations for growth and inflation, and also lowering their expectations for unemployment. Historically, a good Q1 has been a strong indicator for a bull market to continue. History does show that when the S&P 500 gains more than 8% for the first quarter, it has finished higher for the rest of the year 94% of the time, with an average gain of 9.7% for the final 3 quarters. Some stocks did very well in the first quarter. Nvidia, for example, was up 82% and was actually the second best performing stock in the S&P 500, trailing only Supermicro Computer's gain of 255%. Tesla, on the other hand, was the worst performing stock in the entire S&P with a loss of 29%, and the electric vehicle maker is actually lower today than it was 3 years ago. Bonds have been under some pressure to start the year. After bottoming in October of 2023, the Barclays U.S. Aggregate Bond Index surged in the final 2 months, up almost 9.3%, to end the year up over 5.5%. This was due in part to a dovish Federal Reserve meeting in December, which saw yields go lower, helping the Ag to finish strong. So far this year, it has been a different story. Although strong U.S. economic data has helped stocks, investors have also had to pull back rate cut expectations from 7 to start the year to 3 total now. This has caused yields to rise and bond prices to fall. All in all, the Ag ended the first quarter down around 0.8%. As for the return across asset classes, all but one sector, real estate, finished the first quarter up. Leading the way was energy, up 13.5%, followed by communication services and financials, rising 12.68% and 12.44% respectively. Laggards were utilities, consumer discretionary, and real estate, up 4.5%, 3%, and down 1.28%. The economy is doing better than investors have anticipated. On Thursday, the government revised higher its report for Q4 2023 GDP growth, and the economy grew at 3.4% annualized in the final 3 months of 2023. That's an increase from 0.2 from the previous report and comes after growth of 4.9 for the third quarter of 2023. In other words, the economy performed pretty well in the back half of last year. The government's report also said that consumer spending grew by 3.3% during the fourth quarter. As consumer spending makes up around 70% of the U.S. economy, this is obviously a great thing, and corporate profits grew at 4.1%. The PCE price index grew by 1.8% during Q4, and the core rate grew by 2%. While that's in line with the Fed's target, inflation has been trending higher this year. We'll learn more in a few weeks when the next CPI report comes out what inflation is doing. This is encouraging news, but it's dated. Q4 began 6 months ago and ended 3 months ago. Now Wall Street has turned its attention to the outlook for Q1 and the rest of this year. The government will release its first report on Q1 GDP at the end of April. It is currently expected that the U.S. GDP will grow by 2.1%, which is not too hot and not too cold. Lastly, we're getting closer to Q1 earnings season, and analysts expect growth of 3%. For the year, it's expected companies will report 11% growth. First off, is the Fed decision. Will the Fed cut rates in June as the current market expects, or will inflationary data come in too hot for the Fed to cut? Data is crucial to the Fed's decision and to the stock market continuing to chug higher from here. If data is too hot for the Fed, rate cut expectations fade from June to a later date. This would cause bond yields to increase and also put stocks under pressure, as rates could become more and more of a headwind on the U.S. economy and therefore companies' profitability. The next is AI earnings disappointment. While AI is not solely responsible for this rally, it has had a big impact on market optimism. AI-related companies' earnings expectations are through the roof. If they prove too good to be true, we will see selling in mega-cap tech and tech-aligned sectors, and that will hit the markets. It won't end the bull market or the rally, but it could easily give back a large portion of the gains year to date. Next up, economic growth and inflation. If the Fed is wrong and inflation does rebound, it will eliminate a major reason for the October to present rally, because not only will it destroy rate cut expectations, it will put rate hikes back on the table. Higher for longer rates and rising hard landing chances will make this market extremely overvalued, and a substantial decline is possible. A sudden, unexpected slowing of growth is another rally killer, as it negates any benefit from looming rate cuts, which in turn would cause volatility. Positively, economic data does remain resilient, and there is no real sign of a looming slowdown. But if it starts to show up in the data, that is a potential major problem for the markets. Lastly, going back to fixed income, bonds have been under some pressure this year. However, the stock market did something recently that it has not done in over 20 years. The yield on the 10-year US Treasury exceeded the earnings yield for the S&P 500. By earnings yield, I mean the S&P 500's earnings divided by its price. So the equity risk premium has gone to zero. Typically, you would expect to benefit from owning stocks, as they are considered riskier than bonds. Right now, this technically does not exist. Currently, the 10-year Treasury rate's around 4.2%, while the earnings yield of the S&P 500 is 4.1%. This means investors are actually being punished for owning stocks relative to bonds. Now, this does not mean that stocks are overpriced, but rather that stocks are richly valued relative to bonds compared with previous periods. The point of this is to say, bonds are in the portfolio to hedge against stock market volatility, and bonds will outperform at some point. Thank you very much for watching this segment of Market Moves. If you do have any questions, please do not hesitate to reach out.